All right. What's up, yo? Welcome back to Acquire and Operate. We are building a portfolio of super profitable micro SaaS firms, and we are doing it in public for the love of the game. Okay, Lou. Wah, wah, wah.
We've got to
Wah,
get
wah.
those air horns.
Wah, wah, wah. What's up, buddy?
Oh, dude, I was just telling you, it's been such a good week. It's starting to warm up in New York, and you know what that's like for the mentals.
Oh, yeah,
And
totally.
dude, and it's just been a banger week, like for the company, like our portco, just everything outside of it on the personal side. It's felt as though like we've just been crushing and firing on all cylinders. So I'm feeling really good.
Me too. I think what he said. It's I was joking with Marty, like or I kind of measure where I'm at by like, and we joke about it, and I'll censor it for the audience, but like those moments of kind of like it's like the divine algorithm gives you a high five, and it's like all of a sudden these things will just snap clear, and it's like, and you're just like, oh my god. And I had like 3 of those this week where I was just moments of raw clarity. And I was joking with Marty too. And I was like, I just feel like I'm more plugged into the matrix in a obviously good way than I ever
Yeah,
have been. It's just like systems are working for me. It's just like, I guess it's momentum, if we
starting
were
to hit
to
that flow.
like abstract out, just like flow on a daily basis all day long. It's just, it's where it's Nirvana, man. It's what we're all trying to
You
get
know
to.
what? You know what I have to add to that? It's like we took a year to just build the right foundation, and now we're
Mhm.
starting to reap the benefits of that foundation where we could focus on more high level things, and all of the nitty gritty items that were more foundational are just starting to flow in symmetry.
Totally. And anytime I'm hard on myself that like, damn it, why did it take like, we came to Micro SaaS because we can move super fast. I've said it ad nauseum. And so I've just been rationalizing where it's like the momentum that we've built with Portco One is going to translate. It sounds like, yeah, duh, when you say it out loud, but that just gets me so excited for, the second acquisition where it's like, what's the rate of improvement going to be? I think, 20% is probably conservative. I think 30% is realistic. I think 50% is optimistic, but who knows? Especially when you're working with systems, right? They
Hmm.
by design, by definition, they're transferable. So anyway, I'm jazzed. I'm jazzed. I'm jazzed. I'm jazzed. Um,
Yeah,
all right.
that's what it's
Here
like
we
when you do all the hard work, baby.
Yeah, it's like, oh, you need to dig a hole? I already built this robot shovel. Just tell it where to dig a hole, It's like, cool,
Yep.
let's go back to drinking lemonade. Um, all right, so deal teardown for y'all today. We are looking at a SaaS. My mouse just stopped working. That's fun. Parking management SaaS platform with
There we go.
8.7 million in revenues and 1.3 million in profit. This is obviously a deal teardown, and all those numbers were probably like, woo, ooh, 8.7 million. Usually
Starting
we're
to get up there.
talking, hundreds of thousands in the revenue department. So this is going to be an interesting one. Um, in terms of a sense of what's ahead, we're obviously following kind of the typical playbook here. So firm profile, we'll then zoom into the industry outlook, and then we'll do kind of our approach to a SWOT analysis. So we'll look at strengths, risk factors, quick wins, and opportunities. And then we'll look at some market comps. As you'll see, like the asking price is best offer, so we can't back into so I don't know, the market comps are like like there's too many unknowns, and also we don't have as good a market comps for deals at this kind of threshold, but whatever, we gonna jam.
This would be one of those deals I would lean in heavy for due diligence more than any others, like with a
Oh
fine
yeah,
teeth
for
comb.
sure. Well, I think even just as a function of the dollar bills, I mean
Yeah.
this, we'd have to raise an interesting amount of capital to get this deal done, but let me pull up my screen here. All right, I am super, I guess, engaged with this vertical. I'll just read this one out. So, an end-to-end parking management platform that serves private, commercial, and municipal clients. So that's SMB, mid-market, and then public sector. So that's basically every kind of conventional customer segment that exists. Started in October 2018, the business evolved from a mobile app for private parking space rentals into a comprehensive suite, providing solutions for parking space management, enforcement, and payment processing. They got a team of 2 to 20. The platform has shown significant growth, though they didn't disclose the growth, so who knows what that means. Trailing 12-month revenue, as noted, was 8.7 million and profits 1.3. So we'll get into that, but a lot of profit to invest in growth, but as a function of like base rates against comparable SaaS firms, I think there's a lot of headroom for that profit margin. Pricing model is interesting. It's transaction based when it's a two-part tariff. So we've got a fee to use the platform and then a 10% convenience fee to customers. So there's some usage-based pricing and two-part tariff. That's a OG kind of Tom Tungus approach, but that you like that scales linearly with user value, and that's all good. Tech stack is no weirdness there, pretty modern. And then this is where it starts to get funky. So then I think when you start to play with deals at this threshold, you need to start probably moving away or for sure validating base assumptions for Micro SaaS, one being bootstrap founders and a super clean cap table. So this group has a safe round involved. There's some seed equity. There's some convertible notes. So there's a lot of action there, which we'll talk about what that means. So
Fry acting.
yeah, it's a lot. It's like, you got 5 people at the table now and you got to figure out what they all can agree to for lunch. It's like, well, I'm a vegetarian. Well, I don't like tuna. And it's like, oh God, here we go. But anywho, and the vertical obviously is parking management. Cumulative score for us landed at 2.8. And rule of X is 0.14. So we don't know what growth looks like. So rule of X in this context is just purely a function of profit margin, which is about 14%. All right. That is a point of departure. Let's get into Z industry outlook. So global parking management, I couldn't get like solid data on it, but there's some really compelling macro tailwinds. And we'll talk about how this is probably like, this is a niche for sure, but it's such an applicable and large niche that it's probably not a great fit for Micro SaaS, where it's like, hey, how many cities need parking? Everyone on the planet. And it's like, okay, so we have a global TAM that's juicy. That means venture capital is like, cool, let's spend $200 million and go acquire the whole market. But anyway, compounded annual growth rate back to the parking management sector is estimated at around 7 to 10%, 7 to 10%, which is 2x GDP in the United States. So that's ripping and dipping. And there are a lot of trends and industry drivers. So, and some of these are a little bit at odds. And I was actually having dinner with a neighbor last night who's an architect for the city of Denver, and we were and this came up because for the love of the game, it's tough to leave this shit in my office. And
the lifestyle,
and then it was like kind of the tension between smart city initiatives where they're trying to go way more what's the word, walker
sustainable
for sure, but like humans that walk around. And versus kind of, they want bike paths, they want walking sidewalks, they don't want cars.
More like the Amsterdam communities where it's like more people and bikes than there are cars.
Exactly, because that obviously has benefits for the environment. Real estate in a downtown kind of urban dense environment that's just storing cars is kind of wasted. But on the other side, they want cities to be smart, so they need to be thoughtful about parking infrastructure. And we have a long way to go before everybody's riding their bike to work. So
exactly. And I would also push back on that, because when you actually do visit some of these cities, you just trade the parking lots for bike dumps.
Yeah.
The bikes
everywhere. Yeah, 100%. And the scooters, I mean, geez, dude, I remember in the early days in New York, or even now, if I go catch an Avs game, there are scooters left and right, and dudes just eating shit on scooters. Just like
littered, dude, littered. It's come to the point where the city it doesn't even like respond to lawsuits or anything. If a biker or someone on a scooter hits a taxi cab, it's just go away.
It's like, oops, well, you signed something when you enrolled in that app, so have a nice day.
Exactly. We're not liable.
So I think generally speaking, though, every city, like smart city, and she was talking about as a percentage of budget too. Like if you think about like, all right, what do our taxes go to? And it's like streets, sidewalks, and sewers, and like utilities is like 80% of taxes. So that's where all the headcount goes. That's where all the resourcing goes. So obviously this is a priority for most cities. And then obviously there's been some technology advancements. Some of this stuff is OG, but just think like IoT, mobile applications, cashless transactions, all that stuff has kind of converged to be, excuse me, choking on my words, literally, has kind of converged where it's like, ooh, wow, this is like now parking management can be a fully kitted out SaaS based thing.
Yeah.
And then obviously this kind of, we already touched on this, but a lot of stuff around sustainability. Obviously we want to reduce carbon emissions and carbon footprints in general. And that's kind of like a metric that most cities have as like their top 5. Like, what are we doing to reduce carbon emissions? What policies are we rolling out? Are we adopting solar, et cetera, et cetera? And then obviously customers like convenience. And then there's a lot of integration stuff. I think the one interesting integration thing, which I think is an edge in parking management, is electric vehicle charging stations. So this is
Yes.
something that I've seen a lot of, but I think that's probably where this category is going to go in general, where it's less a parking management thing and it's more parking, like a car charging thing. Anyway, those are all tailwinds. That all looks good. On the risks, I mean, I think the only thing that's kind of a pain in the ass is that regulation is literally down to city jurisdictions. So parking regulations could be different in Manhattan than they are in Brooklyn, than they are in the
And that's a
Bronx.
headache.
And it's like, and as you're an operator of this firm, it's like you have to kind of, we'll lean into this, but having some kind of arm that constantly monitors regulatory change is just a sunk cost, if you ask me. And it's like basically kind of having a party and waiting for your parents to come home. You're like, I'm here and I want to do a cake stand, but oh my God, did the door just ring? I don't know. Was that the doorbell? And it's like, okay, like we need to hire somebody to just be a paranoid human and let's get on with our day.
Yeah, it's kind of like if you watch the Uber documentary, that's pretty
Yeah.
much the game they
Oh,
had to play. You know what I'm
totally.
saying? 90% of their time is just regulation lobbying.
And then you got like the cabbies that are coming to like break some knees, and it's like, I want my medallion that has no value. Yeah, totally. That's a whole.
Yeah, when do we get back to building the business?
Yeah, totally. All right, so let's change gears here. So I think industry in some ripping, lots of macro tailwinds, super global. The TAM is extraordinary, and we should all be excited about that because we're business humans. But on the other side, it's like, is this Micro SaaS? I don't know.
Yeah, it's
Or
like
probably
1 foot in,
no.
1 foot out.
It's probably like, no, it's not Micro SaaS. It's niche, or it's vertical SaaS. And I'm not even, and I guess you could argue that that makes it niche, but the TAM is so applicable and universal that you're probably like, no, it's not, but maybe I can be convinced, versus like, maybe it isn't. It's like, no, it's not. Convince me that it is. So anyway, strengths, strong market position, revenue. So, I mean, and it's so funny. There's a lot of these ones that are kind of backhanded strengths, which is like, I guess, becoming a trend. It's like, it's like, you're beautiful, but you're too hot.
Yeah, it's like it's too good to be true.
Yeah. So, and I mean, like if we just think about what we could do with $1.3 million in profit margin to grow a business, you just jump out of your seat. You're like, I don't even know. Like we could just, I mean, the pace of execution on engineering would be insane. The experiments for paid acquisition would be insane. So it's like, this is interesting. This is a very interesting scale for us. On the other side, this is purely in the lower middle market buyout strike zone. So you're going to be competing with traditional private equity buyout funds. And what that means is if you're, what happens to the value of a house that you want to buy if there's 5 people out the door at the open house? Everybody's like, hey, I'll pay $100. I was like, I'll pay 120. The guy's like, I'll pay 130. And then before you know it, you're like, shit, I'll pay 150.
Yeah.
I brought 100, and 50, I don't know where I'm going to come up with it, but we'll figure it out.
Yeah. So like OBO deals, like those type of best offer deals, it's not really in your best interest, especially when the terms are not totally clear and you also don't have a full like insight into like the company's profile. It's a hard sell.
Yeah, totally. So I think headline here is the financials are compelling. It's profitable at a 14% profit margin. That's cool. It's not great in SaaS, but that's cool. But oh boy, if we think it's cool, so are other people.
Exactly.
So I think the other piece is a comprehensive solution. So it's an integrated platform. I did a little bit of diligence on the competitive set, and there were a lot of point apps where it's like, you can kind of find, and it was kind of consumer versus business. And I won't go too hard into that, but this is a platform thing. So they've worked to integrate kind of the value chain, the workflow chain into a comprehensive solution, which from a quick pass seemed pretty differentiated in the market. On the other side, and I chose to talk about this here, back to kind of the TAM discussion, that, this is a multi-billion-dollar TAM, aka venture capital. Hypothetically, network effects here where, people only want to have one pay to park app on their phone. So cool. Let's just pour capital into tipping that market over and becoming the one, winner take all player. All doesn't bode well for Micro SaaS. So there's that. Pricing model we already touched on. 2-part tariff. That's beautiful. It's tricky to move towards, but they've got it in place. And then I think this is kind of interesting, but we'll talk about it on the other side. But the funding and investment is just like, all right, they raised 2.9 million and they did a safe round and they did a seed round and they've got some convertible notes and blah, blah, blah. But they grew the business. So they were able to raise and exploit capital to grow the business. So that's just kind of a signal that things are good. And then lastly, the market's growing. Thoughts? I'm sure. Yeah, all backhanded, basically compliments.
Right. So as you were going through these backhanded compliments, a light bulb went off.
Do
A
share.
marketplace, instead of being one of these companies that are going directly after revolutionizing the parking management space, create a marketplace, because like in a place like New York City, we have icon parking, lazy parking. I probably have about 3 different apps on my phone. If there was just one where I can just choose based on the location I'm in, who has the most available spots, I'll buy into that service, make my reservation, handle the whole transaction. Now I can pick and choose. And as let's say as the marketplace, I'm now just generating revenue from signing up these SaaS companies
Or just
with their customers.
aggregating demand. And then that looks and feels a little more like a consumer app. It depends on the monetization scheme, where it's like we're either going to tax the consumers, but more often like you're bringing demand to the vendors that are operating these parking management spots. So you'd probably tax them to be involved in the marketplace. But totally. And that's the thing, like if there is no kind of clear winner and it's a fragmented market, there's always like those demand consolidation plays, which would be interesting. Mobile app, consumer, go baby go. But that is a two-sided marketplaces are a bitch to make.
I know.
Because it's like, do we need more Uber drivers or more people that need rides? And it's like, well, if we have people that need rides and no drivers, they're going to churn. We have drivers and no people that need, so you got to go like,
it's a balance.
It's very tricky. All right. On to risk factors. So I think this is interesting. And I chose to really elaborate here. Because again, base assumption, Micro SaaS is your audience of sellers are Micro SaaS are bootstrap founders. They have not taken external capital. They get to product market fit, bootstrap. They don't take any money. Oh shit, they're starting to generate revenue. Now there's some income coming into the business. Happy days, right? Whereas this group is not that. So what does that mean? That means the cap table has multiple parties involved. So that means, hey, we want to buy the business. We've got 4 people at the table and they're like, okay, instead of one person where it's like, how do you feel about this valuation? We've got 4 people that are like, well, I kind of like it. Well, I don't know, but we should be way higher. Well, let's take whatever we can get. And it's just like, oh dear God. So there's this consensus that has to be created on the other side of the table, which takes time, burns cycles. I touched on valuation disagreements. This is where it gets interesting too, is that, and I guess this translates into decision-making and consensus, but each of these people has some kind of pref, right? Where maybe the safe notes convert at some, kind of thing. They've been getting paid interest and it functions a lot like debt. Maybe it doesn't, but now you've got even more minutia going into each respective party's calculus around like, hey, what do I need to see to feel like this is a good exit for us? And that's not great. And then that dovetails into due diligence, where it's like, okay, what kind of ownership rights are here, rights and obligations, just look at your attorney fees and multiply them by 3, because it's like, hey, I need you to look at a bunch of shit and it's been signed by all these people and there's been addendums and it's been changed over the times and amended and, yada, yada. And they're like, okay, the clock's running, so I'll get started. Again, all not conventional in Micro SaaS. Anything to add there, Dr. Lou?
Nothing to add there. I think you've convinced me this is definitely not Micro SaaS.
Yeah. Or, I mean, hypothetically it is. I don't know. I'm with you. It's not. That's why we're passing, right? I mean, that's the sum of it.
Yeah.
And,
even when it comes down to the fragmented regulation by like just certain municipalities, like it's a tough play.
And then we get into, regulatory and legal risks, right? So it's like, oh, shit, in Denver, parking, operators can only charge this amount for late fees. Okay, God, we need to update the restrictions on the app in that market so that our clients can, and then, right? I mean, the list just goes on. And you basically have to just make all these little micro adjustments in different markets. which is you got to have some kind of police person internally that's just constantly feeling for that stuff across all the markets you're active in.
Yeah, a cap like that would be good for New York City, so they can't charge you 100% of your original reservation fee.
Oh, dude, I mean, they're so predatory too, which is not a function of the software companies that help enable this stuff. But I had one parking thing where I went in and I'm like, oh, God damn it. To your point, I don't have this app. Download the app, pay my thing. I'm like 4 minutes late and I have a ticket on my car for like $95. And it was like, I paid $10 to park here for an hour. And it's like hypothetical. They could have charged me 10 grand. They're like, hey, this is our parking lot. You stayed longer than you paid for. We're going to tax the living shit out of you. And it's like, all right. So there's very predatory behavior. And
Yeah.
obviously when that kind of stuff happens, then the feds get involved and they regulate. So anywho, all right, let's move on to the juice. Quick wins and opportunities. So a geography, and we need a few more hyphens here. A geography-based go-to-market. I should have hyphened the whole thing. A geography-based go-to-market, or GDM, is most often referred to. So, I guess with our portfolio this is kind of a loaded question. I guess have you ever worked at a SaaS firm where the geographic location was in the top 5 attributes of an ideal customer profile?
HR tech,
Okay, explain.
health tech. It was more so where they were targeting more urban cities
Okay,
because they have larger groups of employees that fit a certain vertical that we were targeting versus especially like when it comes down to their technical aptitude for punching in a time clock on a digital iPad versus a clock on a wall in
yep.
a flyover state. It was like an all-in-one HR and health tech system. So it was better to target more metro geographies versus like middle of America geographies.
Totally. But I guess you could argue that that's a derivative of sector. So it's like
That
we're going
yes,
after tech companies. It turns out they're all in New York and San Fran, Silicon Valley.
exactly.
The other one is totally. So I guess I would say it's not super like it wasn't like, oh yeah, all of these, right? So it's usually like we sell to this industry, we sell to this role, and then we're trying to measure tech maturity or the likelihood of tech adoption somehow. They have a
Exactly.
website that some human judges is above a 2 out of 4. But when it is available to you, or if you're thinking about network based businesses, geography is usually very important. So it's like we're going to start in New
Hmm.
York and we're going to build up the network and kind of hit the atomic unit of that network and then try to repeat it as much as we can. Andrew Chen has done some good stuff on this in his book, The Cold Start Problem. So anyway, in Micro SaaS, it's not always available to you. So when it is, it's great, I guess I would say, or is my point of view, because you can size up geographies pretty quickly. So the first thing would be like, okay, and here's kind of a step-by-step of how you might go through that. So you want to, and you could use a lot of macro demographic data to your advantage here. So it'd be like, cool, I want to just look at the cities that have exploding population growth, and I want to look at real estate investment rates. And then you'd be like, cool, because I think the cities that have more humans and are investing in real estate probably have more cars to park. And then there's going to be
Yep.
more parking. And then you just follow the thread. You might also look at regulatory environment and be like, what's the most stable, easy breezy regulatory environment? And you would measure that by like velocity of regulatory changes that touch parking, whatever. And then it gets tricky and you get into technology adoption. But it's basically like, cool, we want to target markets where we know they're exploding and there's going to be more cars, which will need parking. Cool, there's going to be more parking vendors. That's our target audience. Let's go hard as shit. And then you might look at, let's cross-reference that. So let's say, okay, like the top tier markets are probably already vended up. Let's go after the
Hmm.
markets where we don't see a lot of competitor presence. And this would be an interesting one as an exercise too, is like just to get out there. It's like, hey, we feel pretty good about Billings, Montana. I'm going to go fly out there and rent a car and drive around and see how the hell I park and what software is available. Like you would just get to
Yep.
the guerrilla shit to figure it out. So anyway, I'll leave it at that, but it'd be like, cool. We're going to look at every city in the United States, and we're going to turn this thing into a scorecard. And then we're going to end up with a blended score out of 4 on what are our top priority target markets. Cool. Now you build a lead list against that. So let's
Hmm.
find out who the big parking lot operators are, and then go, baby, go.
Yeah. Another thing is to just follow the Starbucks map of wherever they're planning another
Yeah,
Starbucks or Whole Foods.
I mean, that's a cheat code, dude. Oh my
Yep. Even
God.
gas stations.
Yeah.
Literally where gas stations, Starbucks, and Whole Foods are popping up, go baby go. When
Yeah.
I first bought my house in Texas, that community was so brand new, we only had one gas station. Within 1 year, we had three gas stations and a Starbucks. I was like, they know. They
They
just
know.
know.
They know. And it's rare in our world that you look at real macro demographic data. A lot of times that's housing and developers and utilities providers,
I was just gonna say
commodity
that
vendors.
internet and electric, you watch those two, you know where communities are booming.
Yeah,
Dude,
totally. Because it's like, hey, I trade oil. I'm going to take advantage of some arbitrage here. I'm going to buy oil there and move it over there where it's way more valuable because it's scarce, and have a nice day.
you know what? I think we're looking at the wrong Micro SaaS.
Yeah. Actually, let's just get into commodities trading.
Yeah.
All right. So, and then I guess as an extension of this, so this is again, I guess there, so a segment based go to market. And I think generally that's a function of maturity. So you start with one go to market motion. Like you're like, hey, we're solving for these jobs to be done, these pain points. You try to
Hmm.
solve for as much surface area as you can. And then you realize, well, company profile A and B have slight variations of those pain points, and they buy things differently. So we can cater our go to market to them. And so usually it's like small businesses buy different than large businesses. Small
Yep.
business, you pitch me something that I like, I'll buy it. Large businesses, you got 10 people that have to agree on it. There's established budgets. There might be a procurement function whose job is to beat up vendors and save money, et cetera. So it's worth noting that there are three very distinct and discrete customer segments here that behave very differently. So we've got private owners, which is like Bill, who had a real estate, and he's like, dude, I'm going to turn this into a parking lot, and it's going to be automated, and it's just going to kick off cash, and I'm going to be thrilled. You've got commercial enterprises, which are like, hey, we've got a building that we can rent, or a building that has a parking lot that's not fully, used up. We can rent it. Then you got municipalities that are like, hey, we're building a sports stadium and we're going to have to manage parking, right? So those three people, and I broke down buying behavior and spending behavior for each category, but just think private owners, make it cheap, make it easy to buy, and I'll approve it. Commercial enterprises, they're more kind of operationally oriented. They're trying to create efficiencies. They're thinking about ROI, and there's a decision-making table. Municipalities, 100 million%, you're dealing with an RFP, which is like, we need a parking lot management thing. And then you have to respond in writing and fight to the death to become the vendor of choice. And then
Yep.
if we think about go-to-market motions, it's like, okay, private owners, probably product-led or some kind of non-sales oriented thing. We just drive demand with digital tactics. They can onboard themselves. We email or we mail them the hardware that is no doubtedly kind of accompanying this thing. And then commercial enterprises, now we have to run sales process. Maybe we'll give away a freemium thing to get them on the platform. And then when we see them use it, we'll have a salesperson reach out and engage them. Municipalities is like, we have an RFP team who just sits there and reacts to RFPs and rips demos and just hustles. And all those things require different resourcing. The operating model is very different. So the cool part is you can optimize for each of these segments and really improve outcomes. I guess the pitfall is trying to eat the whole pizza pie at once. And it's like, well, we're going to do this and that and this. And so again, back to, I guess, power law and Pareto principle, I would suggest that 20% of their users fall into one segment, and those users or accounts are generating 80% of the business impact as a function of lifetime value, which is revenue against churn. So I think probably the tendency here is to find out which segment is performing the best and recalibrate the entire go-to-market to go gobble up as much of that segment as you can. And then once you're like, hey, we've got really strong momentum here, move on to the next segment. And that would basically, I guess, require re-kitting out your whole sales organization, your whole go-to-market organization. So
Yeah, and realistically, it's going to be at the city level because they've started to lean into the commercial side and share public parking spaces with digital systems. So there's going to come a point, I feel, from just being, I mean, every time I leave my house, I put my car in the garage. There's like no street parking anywhere in the city. So I feel based on what I'm seeing, at a certain point, it is all going to be city ran and regulated.
yeah,
You're going to be working directly with them.
yeah, and it takes some real courage to sell to Publix. It's like, hey, we've got this cool thing for public schools. It's like, oh God. Or hey, we're going to sling this app to healthcare. It's like, oh God. good luck.
Yep. You're
Godspeed.
up all day and night.
Yeah, have a nice day. All right, into market comps. Again, we don't have a lot of information here, but I think it's interesting to look at comps. So, and let's just look at comps. So,
I love the comparables. This was
yeah,
very insightful.
yeah. So, asking price is 23 million for, again, a company producing 8 million in revenues. That's a 2.7x multiple, which I thought was going to be higher. But again, we don't have as many comps to inform these base rates. So take them with a grain of salt. Or said another way, most of our base rates we can look at like across 500 deals and we can inform that. With this, we're looking at across like 10, right? So those averages are less, like they're less statistically significant. I would say
Yep.
very few comps achieve statistic relevance, but this is very far away. Trailing 12-month profit margin is 1.1 million. I'm sorry. Oh yeah, 1.1 million. Oh shit, this deserves a thumb up. My bad. I'll update that. So we've got 200K better for our group, which is great. And then the comparable growth rate was 89%. I was like, shit, that's some serious growth for a firm punching at 8 million. Like they're very quickly going to be out of this lower middle market threshold. So anyway, and the growth stuff too for a lot of listed firms, you got to take with a grain of salt. It's like, let me see the growth and like what growth. Oh shit, you thought this was this kind of growth? Like this is not the growth we look at. So
yeah.
Anyway, concluding thoughts. Okay, Lou, what do you think, bud? Do the deal?
No, I'm gonna have to pass on this deal. There's too many unknowns, and while it does feel really juicy and like a great opportunity, it feels as though we would have to get out of this business faster than we can stay in. Like, for example, it wouldn't be a long-term hold because at that point, now we'd just be playing politics with the powers that be.
Yeah, totally. Well, and
I
the
don't
other
want
thing
to do
too is
that.
like, there's so many network-based businesses that have achieved such interesting scale where Uber is like, yeah, we're going to do a parking thing now. And it's like,
Mhm.
fuck. Like,
Yeah.
like, no, please buy us, buy us, buy us.
Yeah.
So
Or like all the hotels in New York now doing their own rental apps, room rental apps, or working with Kayak just to work against Airbnb, and then getting the cities to pass policies to block Airbnb altogether. It's you build a business up so much just for someone else to say, hey, whoa, you're taking market share. Stop.
yeah, it's like, and I think to like state a blanket statement, it's too close to utilities and infrastructure, which is too close to publics, which is a recipe for a frustration sandwich.
Politics with the powers that be. I
Yeah,
do not want to
I
play
don't
that
want.
game.
Yeah, I really don't. It's just like,
At
ugh.
least not yet. Not in
Yeah.
the Micro SaaS level.
So I think big picture, it's like cool, healthy revenues. They've gotten to a milestone that is rare, and they've done it profitably. That's dope. They've got a super complex cap table, so no matter what, this is going to be probably 6 months of diligence, right? And we're shooting for 3 months top, so the velocity of the deal is going to slow down a lot, and this increases kind of the existential risk of the deal. Where you talk to a lower middle market investment banker, and it's like, what percentage of deals literally fall apart at the 11th hour or like the week of closing? They're like,
Yeah.
half, because it's like, oh God, this thing that we didn't, oh, no deal. And you're like, oh my God, I spent 6 months and 50 grand to get the deal, or at minimum, right? And I've spent $1 million in diligence to get to this place. Oh my God. So and that's part of the game when you play kind of traditional models. So that's not great. And then the regulatory stuff is the pits, and that's all not fun. And then all the while, you're going to be competing with institutional players to get the deal done, which is going to drive up valuation, makes it infinitely more difficult to generate a return. And yeah, I think that's it. So we're past. This is more of a true private equity deal, and I would say there's going to be competition from a shitload of venture funds if this is a compelling narrative. And all the while, the government is ready to just ruin your day.
I would say if you have, let's say, a large fund with a diverse portfolio, and part of that fund was a commercial real estate fund where you have hotels, places with actual parking lots, and a need for an app like this,
Yeah.
that would complement the portfolio. But for our strategy, it's not a good play.
Yeah, great synergy for developers, for hospitality folks.
Yep.
There's a lot of this is just kind of a tech kind of supercharge for what they're doing, which should
Yeah.
reduce, operating costs and make whatever they're doing more profitable or add new revenue streams. All the shit that they do that motivates those deals. Okay, Lou, that's a wrap, my G. Pleasure as always. Hope you had some fun. I had some fun. This is a
It's
club
always
banger.
fun.
All
Yeah.
right, my guy. I'll catch you next week.
All right.
Lasers. Let's get some lasers. Oh, the laser beams. Let's go. All right, buddy. Peace.
All right. Peace.